Hi, today GameStop stock was down over 40% after its meteoric rise the last few months, up several thousand%, down over 40% today after news that several established trading platforms announced restricted trading, effectively limiting any new buyers to come to the market, letting it sort of liquidate out. So why the restrictions? The answer is that our entire financial system could be at stake. What? How is it possible for a dying retailer to potentially maim a global financial system? And we'll get into all this in this video. I'll discuss why I think the trading curbs by these trading platforms, by these brokerages, are actually critical to the stability of the financial system. First, a quick 10-second plug. My name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. That's usually my focus, but because this situation is playing out in a very interesting way, I felt like it's worth calling out. For those that are interested, this is what I normally focus is multi-baggers, types of companies that can go up hundreds of thousands of percent. Make sure you subscribe. If you're already a subscriber, I appreciate that thumbs up. And if you want to follow my personal journey to see what are the potential multi-baggers that I'm buying for myself, go to unrivaledinvesting.com, click on journey. So what's going on? Earlier today, Robinhood announced, hey, amid this week's extraordinary circumstances in the market, we made a tough decision to temporarily limit buying for certain securities. So this is limiting new buyers to this situation with GameStop, as well as several other securities. As a brokerage firm, we have many financial requirements, including SEC net capital obligations and clearinghouse deposits. Think about clearinghouse. That's going to be the magic word throughout this video. Some of these requirements fluctuate based on volatility in the markets and can be substantial in the current environment. These requirements exist to protect investors in the markets, and we take our responsibilities to comply with them seriously, including through the measures we've taken today. I.e., we're limiting the number of potentially new buyers that can come to this situation because there are some liquidity requirements that we have, some regulatory requirements that we have in order to make sure that we stay in business and make sure our customers can, effectively keep their money so that we don't blow up. Now, it's funny, you see, this is a really bad take in all honesty, because Robinhood has had this sort of image of like, hey, we are democratizing finance. We are bringing trading to the everyman. And look, when you trade, huzzah, like these prizes go off, and every time you trade, they're gamifying it. And this is just such a, the immediate take is like, oh, you're the one that's that's encouraging the masses to do it, and now you're not allowing these very masses, because, this is driven by some Reddit groups, Wall Street Bets, sort of saying, hey, we think this can go to the moon, let's all sort of coordinate together and make it happen. And the immediate take is like, man, this is a really bad call. You have this guy, Justin Kan, who said Robinhood not allowing trading of GameStop and AMC. The elites have financial system rigged. Why would any user trust Robinhood ever again? And another folk, he's sort of tying you start getting the tinfoil hat on, the conspiracy theories of, and look, there might be validity to some of this. Like in October of 2020, Citadel paid our new Treasury Secretary $337,000. Now, first of all, I agree that's just redonkulous. There's no way those speeches are worth it, and that is something that needs to get solved independent of this. Like, there's no reason, if you work in government, that you should be able to do speeches for hundreds of thousands of dollars. That said, they'll do loopholes somehow. So Citadel paid our new Treasury Secretary $337,000 for a speaking fee. Citadel owns a portion of Melvin Capital. Melvin Capital was the one that was shorting this and is one of Robinhood's top customers. So Citadel pays Robinhood for order flow information to front run investors, and that's sort of what Flash Boys is all about. That's what high frequency trading is. And so Citadel is sort of like, hey, the whole implication of this is that these major institutions don't like the fact that GameStop has been going, just, it's the singularity. It's going straight up. And they're like, well, these major players, these sort of shadowy players, Citadel, Melvin, coordinating with government is trying to hold the everyday man down. And that's sort of conspiracy theory starts going. And then you actually start getting the politicians and wannabe politicians with AOC saying, this is unacceptable. We now need to know more about Robinhood's app decision to block retail investors from purchasing stock while hedge funds are freely able to trade the stock as they see fit. And then Donald Trump, any Republican in Washington D.C. worth a damn, should be calling for an immediate investigation investigation into Robinhood and Citadel. I honestly, I find this amazing. Like, this reminds me of that scene in Ghostbusters 1 where they're talking to the mayor and they're like, look, like the mayor's trying to figure out what to do. There's ghosts all over the place. And I think Peter Venkman's like, look, dogs and cats living together, mass hysteria. And that's what you have here. You got people from across the aisle are upset about this decision. And honestly, the problem is that this is a first level thinking. With finance, you often have to dig a little bit deeper to actually understand what's going on. And that's honestly what I try to bring about with this channel, is saying, hey, we need to peel this back a little bit to actually understand that there's a bigger problem here beyond just this sort of conspiracy theory of, hey, maybe these investors are in a tough spot. So, yeah, but it's funny, you know, you look at this and there are some folks that find humor in it, you know, so you got to find the humor in situation. So one guy, he's saying, jumping into AMC trade here, all profits will go to charity. He's making fun of Chamath Palihapitiya, who bought some options on GameStop and then immediately made like $500,000 and gave the proceeds to charity. It gave to Barstool Sports. And he goes, if I lose money, I'll steal some money from a charity to get back to even. Very funny. And then this other fake accounts. So I bought GameStop at the beginning of the year and now I'm up 1,900%. And totally unrelated news, my ex-wife wants to get back together. I love it. I love the humor on FinTwit. It really cracks me up. But the reality is that looking past this humor and first level thinking is that you need to take this deeper dive and to actually understand what's going on and how the whole financial system could potentially be at risk, certainly can get maimed and sort of thrown off track without intervention, without changing the game. And it's changing the rules that are upsetting everyone else. But you need to understand why the rules get changed from time to time. And so here's Andy Kessler, and he is exceptional. I've read, I think, every book he's written. He is one of the original VCs, if you go back to the 90s, that have that crushed it. And so here he wrote, scandal of GameStop, AMC, Bed Bath will not be Robinhood, or BlackBerry, will not be Robinhood app cutting off customers buying shares, but prime brokers, Goldman Sachs and Morgan Stanley, and others previously lending more than 100% of the float to short sellers. Not supposed to happen. That's the bonfire that Reddit lit. He is 100% right here. Everyone else focusing on Robinhood and trading restrictions with the various different trading platforms, you're missing the bigger point. The big point is that over 100% of the shares outstanding have been sold short. That's a big problem, because if you get some sort of coordination like you had on Reddit with Wall Street Bets saying, hey, let's all buy this, let's all limit the number, let's effectively limit the float as we become a buyer, and the stock price starts going up, you have all these short sellers. That's more. You have more shares sold than there are actual shares outstanding. And as they say, oh man, I need to get out of this bet, I need to buy back those shares, there simply aren't enough. And that's the problem. Think of it, if you haven't watched my first video on GameStop, the way to think about this in terms of short selling versus options, because this is a problem created by options, this is a problem created by short selling, naked short selling in particular, is that you should think of it as musical chairs, except it's with money, and you have two people playing musical chairs, and they have infinite money. And the reason why it's infinite money is because you have brokers, and then bigger brokerages and clearinghouses all the way down, and then major banks. And so it is effectively infinite money when you start thinking about the snowball effect. And if you have two people playing musical chairs, except you absolutely need to get into that chair. And if you absolutely need to get in that chair and you have two people that are effectively willing to pay infinite amounts, the price of that chair can go up to infinity. That's the problem with short squeezes, is that if you do not sort of restrict the trading, or if GameStop were to start issuing shares, more shares, you could create a problem where the price effectively just goes parabolic. Keeps going. It's already gone up parabolic. It's already gone from $5 to 300 to 500 one point earlier today. But when you have a situation like this, when you literally have more shares sold than there are actually available to own outstanding, you could create this dynamic where they become effectively $1,000, $10,000, $30,000 per share. because of this dynamic. And then you go, well, wait a second, explain how it could get so much value. Like how could the share price go up so dramatically? Well, once again, it goes down to this musical chairs aspect. Well, how come there's so much money involved for what I thought was just a dying retailer? So here's all the trading platforms that, and I think there are probably more by now, that have said, hey, we are either limiting new buyers or doing some sort of restricted trading around these situations. Why are they doing it? So here's Thomas Peterffy, and he had a great Peterffy, and he had this great interview with Bloomberg. I'd highly recommend it if you're interested. And so you first need to understand that there's around 3 million option contracts outstanding. A lot of them were issued way earlier on when it was trading at $5-10 a share, and the average price of those options are now around $10,000. This is all what he was saying, and that implies the value of those options is around $30 billion. And the way options are generally structured is that it's a zero-sum game, which is that there's a winner and a loser to almost pretty much all options, and so that if you have $30 billion in option value, you have $15 billion of winners and $15 billion of losers. This is where I'm highlighting a couple of the key aspects or excerpts from the interview that I thought are worth knowing. So is there any risk that there wouldn't be settlement, i.e. that these trades won't go through? And this is critical. He goes, of course, and keep in mind, he's the founder of Interactive Brokers. He's been a revolutionary in terms of finance. He's wicked smart, and he knows what's going on. So he goes, of course, effectively, there is risk that people effectively won't be able to settle these contracts and make good on them for a stock that's gone parabolic. Because if the losers cannot pay, then the brokers have to pay the winners. Now, there are a bunch of smaller brokers in this game that don't have equity to do that. If they blow up, then the clearinghouse doesn't get paid, i.e. the clearinghouse where all these trades go on doesn't get the money, and that's a big problem. And then they have to take over the positions of the brokerage firm, because if the brokerage firm doesn't have the money, because they're like, oh man, these accounts don't have enough cash to actually cover these positions, these short sales, or they're selling call options, they're selling naked call options on a position. If you have something like that, you effectively bankrupt one brokerage, and then the clearinghouse has to take over that brokerage, and then what does the clearinghouse do? And that's where he goes, has to liquidate them, which pushes the market further, i.e. the clearinghouse takes over the brokerage positions and starts clearing out those positions, in which case, and reversing their positions. Oh, there's a net short exposure, we need to start buying that, and we need to sell these other positions we're liquidating. So that larger and larger brokers can fail because the remaining brokers need to make good on the clearinghouse losses. I.e., this is a problem that's going to start spiraling if it's not controlled intelligently. If you don't have effective curbs to limit this from going to 1,000, 10,000, 30,000, especially when you still have a share count that's a amount of shares short that is more than the actual shares outstanding. So he's effectively saying this problem can spiral. He goes on, there will be $15 billion in losses at this point, some of which will be uncollectible, i.e. there are customers with these trading platforms, with these brokerages out there that effectively don't have the money to be good. Maybe they could cover, maybe they were selling calls on GameStop, or they were short GameStop. They're like, what, this thing got expensive. This was expensive at 60, and then it went up to 500, and they no longer have the money to do that. They don't have the money to cover it, and so they're saying, look, at that point, these folks aren't good for it. Then the brokerage has to pay for it. If a brokerage has enough losses where they can't cover it, the clearinghouse has to cover it, and the clearinghouse gets the funds from other brokerages, and they liquidate the existing brokerage. So this really, you can see how this starts to spiral. We have an audit, so now he's talking about Interactive Brokers, where he goes, we have an automated liquidation system, so we do not have a problem. I.e., if we see people with margin loans, and that's another key aspect of this. Some people, there's an article that my brother pointed out to me earlier today of how this kid mortgaged his parents' house, got a second mortgage to borrow more money effectively to buy, I think it was GameStop stock or it was AMC. And it's like you're margining using more and more debt, and if the position goes dramatically against you, you're out of the game. and they have to liquidate all your holdings, and there's a good chance you may not even have the proceeds to cover it, in which case they eat the loss. So they say, look, we have an automated liquidation system, so we do not have a problem, i.e. they're constantly checking everyone's accounts to say, hey, as these securities are moving, do you have enough liquidity in your accounts to cover whatever margin loans, whatever open option positions you have that you need to settle? But I believe that there must be other brokers who do, i.e. there are other brokers right now who do have a problem. That is a big red flag. Unless we restrict trading, this problem is just going to snowball. And even those of us who do not have problems could have problems if there are too many bankruptcies. This is a big deal. He's saying, look, this, red alert everyone, this thing going parabolic means that some of the existing trading platforms, if it keeps going that way, let's say it goes from 500 to 1,000 to 1,500 or something like that for GameStop stock, if you have a movement like that, then the existing trading platforms may not have, their customers will go bankrupt, and they will have to cover the losses for their customers, and they may not have enough capital to cover the losses for their customers. So how does this snowball? Let's see what's been reported with Robinhood. In a Thursday blog post, Robinhood described its much maligned earlier decision to limit trading as tough, but about risk management. Risk management is, i.e. we need to stay in business. We're beginning to open trading for some of these securities in a responsible manner. We'll keep monitoring market conditions as we look to restore full trading for these securities. Given these conditions, I suspect that they're going to be looking at their net exposure through their clients, and if the stock price starts going up dramatically, they will put another full stop on it, saying, look, we can't have we're not going to add to the problem here. This is the problem here, is if you have two people circling around a chair and they have infinite money that they need to spend effectively to get into that chair, and people know the price of that chair is going up, having a trading platform where it's like, oh yeah, we want more people bidding on that chair, that is a terrible idea. That is why you need limitations on new buyers getting into the situation. That's what they're doing. So if they're saying, yeah, it's going to be in a responsible manner, hopefully it's a way we're saying, hey, we're not trying to add new people to this, because they see, oh, there's two people circling this chair, and they both need to get it, and they're both going to spend $1 zillion to make it happen. CNBC, so Robinhood's talking about risk management, making sure they stay in business, and they say CNBC and Bloomberg News both reported that Robinhood has tapped all of its credit lines, i.e. everything that they can borrow, they have. Robinhood is planning an initial public offering sometime this year. This publicity, which first level thinking is going to be very negative, second level is like, hey dude, this is about survival. Bloomberg said the commission-free online broker that has become popular among a young demographic of investors has tapped at least several $100 million of credit, citing people familiar with the matter. Robinhood's lenders include JP Morgan Chase and Goldman Sachs, Bloomberg reported. The reason why this is important is that it always stems back to the bankers. And so that if several $100 million, are being lent, and you start getting this snowball effect. Well, what if they go under? What if, the GameStop exposure results in a dramatic loss for them, and then it results in this loss for Goldman Sachs? Now, Goldman Sachs, they probably have the balance sheet to handle, many $1 billion in losses. They have something like $90 billion in equity. So they could handle it. But if you have something where, let's say, many trading platforms, several different brokerages start going bust, and their customers aren't covered to the full, you have federal coverage up until a point of like $250,000. But after that, if you have, marketable positions, you don't get full coverage. You don't get full, if a brokerage goes out of business, that's it. It's something like $250,000. So if you're above the federally insured amounts, that's a big deal if your brokerage firm goes out of business. And so that's why this is such a concern, is that if GameStop does go parabolic and these other banks, other brokerages can't support it, then they start borrowing money from others, and then they start going bust and their clients start going bust, if your clients start going bust, then it really does have a ripple effect, because those same clients probably have investments in companies in Goldman Sachs, in JP Morgan, then they don't have money. That's how you have this dramatic tightening of the monetary conditions. And that's honestly, that's what we've seen before. I mean, there was a financial crash in 1907 that was effectively driven by bad banking and lending for a couple of folks looking to corner a market, just like you could argue is happening with GameStop. A little different, but same dynamics. Lending, margin, more debt, borrowing going into a trying to get a short squeeze. You get these sorts of dynamics. And then the bad effect is if it's left sort of, hey, free markets always work, they don't. And this is a classic example of how free markets do not always work, in that you let these parties just sort of get to it, and that the free market allowed, Goldman Sachs and Morgan Stanley to short more than 100% of GameStop. And if you don't have real intervention where you're saying, hey, we're going to limit trading, you're going to see a lot of these folks potentially blow up. Because if GameStop stock keeps a parabolic move, where because it's that chair and there's two people that are bidding for it, it goes from 300 to 3,000 to 30,000 to 300,000, because effectively the price goes infinite if you were to truly leave that sort of bidding situation unaddressed. That's the risk, the theoretical risk with this. So what can you do if this actually continues to snowball? Now, I'm personally hopeful that you'll have intelligent minds sort of say, hey, we can't add more gasoline on this fire, and say, hey, let's get more and more buyers in this situation. We need to sort out who's short, who owns the stock, and just sort of let this settle over time versus let's get this party started. So I'm hopeful that rational minds will prevail versus first level thinking of like the dark arts and evil folks behind this. They're screwing the retail investors. Like, everyone cool down a second. Like, let's actually understand Robinhood is borrowing money to make sure that they're going to be okay. That's a big deal when a company draws down on fully on their credit lines. Like, that's not, I wouldn't say it's a red, it's an issue. It's like, as a company, it's like saying, hey, we just want that cash just to be sure. That's what it means when you're drawing down on your credit lines. Like, yeah, I think you can get that. So as I'm looking at it, like, if calmer heads do not prevail and rationality does not prevail, let's say they open it right back up to trading and it starts going parabolic again. That is certainly possible. Or you get the GameStop folks and they're like, I've had enough, and everyone's like, you know what, I'm happy to sell out of this position, like, no more, and Reddit moves on. So that's possible. You definitely have that possibility, and then hopefully the whole thing blows over. But if you have folks that are like, send this to the moon, this can go to infinity, that is where, and if you have enough people believing that, that's where you actually start having real problems. So will rational minds prevail? Will this situation effectively be controlled in an intelligent way? Or will free markets sort of result in a spiraling snowball that can bring down the market, or bring down many different brokerage firms? That does pose a real risk to the financial system, because you do get this snowball effect that Thomas Peterffy is clearly concerned about. So what can you do? And, for me personally, I just posted a video exclusively for Journey subscribers about the pros and cons of hedging one's portfolio. So that's something that, if you're interested in learning about, hedging and, how you might want to think about it, that's against, protecting yourself against an unexpected dramatic market drawdown. That's not for the situation that, hey, this brokerage just went out of business, because in that case, you're going to be SOL. But for the most part, if you have a dramatic market drawdown, hedging can be very valuable. But that's just one, type of the exclusive content I have for Journey subscribers. You go to www.unrivaledinvesting.com, click on Journey, and there's a lot of stuff there. There's a monthly update of my portfolio. You can see what are the potential multi-baggers that I'm trying to buy for myself. I also have interim updates of what I'm buying, what I'm selling, educational series like this hedging content. And the goal is that each month I try to identify at least one potential multi-bagger or a stock that can go up hundreds or thousands of percent potentially over time. I already called out, my January and even potentially February as well. I've already posted those, and I've had several months. And actually, I'm going to do another video shortly about how ARK just bought ARK has bought for the second time one of my potential multi-baggers. That's already done pretty well. But the reality is just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey to try to find these potential multi-baggers, go to unrivaledinvesting.com. And if you enjoyed this video learning about the disaster that is GameStop set up in terms of how the free market forces have just gone out of hand, dogs and cats living together, mass hysteria, please make a point of subscribing if you're already a subscriber. I really do appreciate that thumbs up, and thank you so much for watching.